In a 2-hour interview with Time magazine, President Donald Trump declared that his administration had successfully completed 200 trade agreements. However, no official records or detailed public disclosures have been issued to substantiate this claim. This lack of transparency immediately unsettles global markets, where trust in verifiable trade policies is fundamental to economic stability. According to Bloomberg, investors react sharply to unconfirmed trade statements, often triggering defensive repositioning across stocks, commodities, and currencies. If these 200 deals fail to materialize or lack enforceable terms, the consequences could ripple across global supply chains, delaying shipments, distorting inventories, and elevating operational risks for multinational corporations. Moreover, American exporters, particularly in agriculture, manufacturing, and energy sectors, could face unexpected trade barriers or deteriorating partner trust, undermining their global competitiveness. In the broader context, ambiguity over such a significant number of trade deals risks intensifying global economic fragmentation, reducing trade flows, and impairing consumer confidence at a precarious time for the world economy. During the interview, President Trump compared his role in trade negotiations to that of a store manager, suggesting he sets the prices and determines who is allowed to buy and sell with the United States. This analogy underscores a transactional and highly centralized approach to U.S. trade policy, framing the nation's global economic relationships as conditional and selectively granted. From an economic perspective, such a view risks alienating long-standing trade partners, introducing uncertainty into global supply chains, and undermining the rules-based international trading system. According to CNBC analysts, portraying U.S. trade as a discretionary transaction could encourage retaliatory measures, disrupt bilateral agreements, and incentivize countries to seek alternative markets. Furthermore, positioning the U.S. as a gatekeeper in global commerce elevates the risk of politicizing economic relations, making trade policy more unpredictable and amplifying tensions with allies and rivals alike. The Trump administration has announced a 90-day suspension of new import tariffs on global goods, offering a temporary reprieve amid ongoing trade tensions. Simultaneously, trade negotiations with South Korea are reportedly progressing at an accelerated pace, signaling a possible breakthrough in one of America's key bilateral economic relationships. This 90-day tariff freeze could be seen as a strategic pause, aiming to ease international pressures, stabilize financial markets, and provide diplomatic space to finalize critical agreements. According to Reuters, temporary tariff suspensions can boost market sentiment, but also create strategic ambiguity as trade partners scramble to adjust to uncertain policy timelines. If negotiations with South Korea succeed, it could serve as a template for resolving other trade disputes. However, failure to secure lasting deals within this window risks reigniting market volatility and eroding U.S. credibility in future talks. Trade negotiations between the United States and China have been officially confirmed as ongoing, offering a rare opening amid escalating economic tensions. However, Chinese officials quickly tempered expectations, stating that no meaningful progress has been achieved thus far. This divergence highlights the deep structural gaps between the two economic giants, particularly on issues like technology transfers, market access, and state subsidies. According to WSJ analysts, early-stage negotiations with minimal deliverables can destabilize financial markets by raising hopes prematurely, followed by sharp corrections when talks stall. If no concrete agreements materialize soon, prolonged uncertainty could pressure global supply chains, encourage regional trading blocs to bypass US-China channels, and dampen global economic growth prospects. President Trump expressed readiness to meet with Iran's supreme leader during ongoing negotiations over Tehran's nuclear program, signaling a potential diplomatic pivot. This move marks a significant shift from prior hardline stances, suggesting the administration may seek direct engagement to de-escalate nuclear tensions. However, Iranian officials have historically demanded sanctions relief as a precondition for any high-level talks, making the pathway to a substantive agreement highly complex. According to Reuters, sudden diplomatic overtures without clear frameworks can unsettle energy markets, particularly oil prices, which are highly sensitive to Middle East stability. If talks between Trump and Iran's leadership were to succeed, it could reshape geopolitical alliances, reduce sanctions-driven economic isolation for Iran, and potentially lower global energy price volatility. President Trump firmly rejected accusations of expanding presidential authority, emphasizing that he is merely exercising the powers granted through democratic election. This defense comes amid heightened scrutiny from political opponents who argue that Trump's aggressive executive actions risk eroding constitutional checks and balances. According to WSJ political analysts, framing the use of executive powers as electorally sanctioned can resonate with a populist base, but simultaneously deepen institutional mistrust both domestically and internationally. Unchecked perceptions of executive expansion could also unsettle financial markets, as businesses and investors generally prefer policy predictability rooted in stable institutional frameworks. In the broader global context, strongman-style governance narratives, whether real or perceived, tend to complicate diplomatic relations, trade negotiations, and foreign investment flows into the U.S. President Trump asserted that the United States is earning an additional 25% on imported cars, steel, and aluminum due to the administration's newly imposed tariffs. While tariff revenues have indeed increased, economists caution that the broader economic impact is far more complex, often shifting the cost burden onto American businesses and consumers. According to CNBC reports, tariffs typically act as an indirect tax on domestic industries, raising input costs for manufacturers and potentially reducing competitiveness in global markets. Moreover, retaliatory tariffs from trading partners can erode U.S. export volumes, leading to job losses and slower economic growth, particularly in industrial and agricultural sectors. If sustained, the 25% revenue gain could be outweighed by long-term structural damage to U.S. supply chains, inflationary pressures, and weakened global trade relationships. President Trump projected that the U.S. economy is poised for a major boom in the near future, attributing the anticipated surge to his administration's policies of radical transparency and expanded trade negotiations. The concept of radical transparency suggests that open and aggressive disclosure of trade intentions and economic strategies will build trust among global partners and stimulate investment flows. However, according to Financial Times analysts, radical transparency without consistent follow-through can create confusion among investors and foreign governments, leading to volatility rather than stability. Expanded trade negotiations could indeed unlock new opportunities for American businesses, but unresolved trade tensions and retaliatory measures could equally offset potential gains. If effectively executed, the combination of transparent policy communication and aggressive trade deal-making could drive stronger GDP growth. However, inconsistent messaging or failed agreements could just as easily derail recovery momentum. President Trump announced that 18 trade agreements are ready for formal release, noting that negotiations with South Korea are advancing faster than initially anticipated. This revelation signals a concerted effort to showcase diplomatic victories and reinforce the administration's narrative of revitalizing America's global trade position. According to Bloomberg analysts, accelerated deals with key allies like South Korea could help the U.S. counterbalance rising Chinese influence in Asia-Pacific trade networks. However, critics warn that rushing to finalize multiple agreements without deep structural commitments could limit their long-term economic impact and expose the US to future renegotiation risks. If these agreements succeed in securing broader market access and reducing trade barriers, they could significantly boost US exports and solidify strategic alliances at a critical geopolitical juncture. China has suspended the import of 12,000 tons of American pork and imposed a staggering 172% retaliatory tariff, dealing a severe blow to US farmers already reeling from trade tensions. The move escalates the ongoing trade conflict and underscores Beijing's strategic targeting of politically sensitive agricultural sectors to maximize domestic political pressure within the United States. According to Reuters, agricultural exports are often the first casualties in trade wars, as they represent both a critical economic sector and a key voting bloc in US politics. The 172% tariff effectively prices US pork out of the Chinese market, redirecting demand toward alternative suppliers such as Brazil and the European Union, further eroding America's share in the world's largest meat market. If sustained, these punitive measures could lead to widespread farm bankruptcies, ripple effects across rural economies, and heightened political backlash against protectionist trade. China has formally rejected scheduled deliveries of Boeing aircraft and redirected its purchasing commitments toward Airbus, deepening the fractures in US-China commercial relations. This strategic pivot strikes at one of America's flagship manufacturing sectors, undermining Boeing's global market share and eroding a critical pillar of US high-value exports. According to CNBC, aerospace exports have historically been a major driver of US trade balances, and disruptions in this sector could widen the trade deficit while costing thousands of American jobs. Moreover, Beijing's preference for Airbus signals a broader strategic realignment, aiming to reduce reliance on American technology amid intensifying geopolitical rivalries. If this trend continues, Boeing's long-term competitiveness could be severely impaired, accelerating the fragmentation of global aviation supply chains and bolstering European aerospace dominance. China has discreetly relaxed certain retaliatory tariffs on US semiconductor imports, acknowledging a critical shortage of viable alternative suppliers. This subtle policy shift highlights Beijing's strategic vulnerability in the global semiconductor supply chain, a sector where American firms still dominate key segments of high-end production. According to Financial Times, semiconductors represent the choke point of modern economies, and supply disruptions can cripple industries ranging from consumer electronics to national defense. The easing of tariffs suggests a tactical compromise, maintaining political pressure while ensuring continued access to critical components necessary for China's tech and manufacturing ambitions. If prolonged, this partial tariff rollback could stabilize fragile tech supply lines between the two superpowers. But it also exposes China's ongoing dependency on US technology at a sensitive geopolitical juncture. Global financial markets remain on edge, closely monitoring for definitive outcomes from ongoing trade negotiations, particularly between the United States and China. The absence of concrete agreements has left investors navigating an environment of heightened uncertainty, characterized by volatile equity movements, fluctuating bond yields, and erratic commodity prices. According to Reuters analysts, prolonged ambiguity in trade talks can depress business investment, delay corporate expansion plans, and undermine consumer confidence, slowing overall economic momentum. Particularly in sectors highly sensitive to tariffs, such as manufacturing, agriculture, and technology, the lack of policy direction continues to weigh heavily on operational decisions and global supply chain realignments. If a comprehensive deal between the US and China fails to materialize soon, financial markets could face renewed turbulence, amplifying risks of a broader economic slowdown. President Trump stated his belief that China's dependence on access to the U.S. market outweighs America's reliance on Chinese imports, framing this asymmetry as a strategic advantage in ongoing trade negotiations. This perception underpins a hardline negotiation strategy, leveraging America's status as the world's largest consumer economy to extract favorable trade concessions. According to Bloomberg analysts, while China's economy heavily relies on exports to sustain growth, the U.S. consumer market is also deeply integrated with low-cost Chinese manufacturing, creating mutual vulnerabilities. Overestimating America's leverage could backfire if supply chain disruptions, higher consumer prices, and retaliation from Beijing offset any perceived negotiating gains. If successful, Trump's gamble could reset global trade terms in Washington's favor. If miscalculated, it risks deepening global economic fragmentation and accelerating efforts by China to diversify away from U.S. markets. Walmart, along with top executives from Target and Home Depot, publicly endorsed President Trump's tariff policies, citing strong first-quarter earnings and emphasizing that a majority of their products are manufactured domestically. This unexpected support from major retail giants suggests that segments of American supply chains have become more resilient to international trade shocks than initially feared. According to CNBC, the ability of large retailers to source domestically could shield them from tariff-driven price hikes, while smaller businesses relying on imports face greater vulnerability. However, analysts warn that resilience at the top does not fully reflect pressures across the broader economy, where medium-sized enterprises and low-income consumers still absorb hidden costs from disrupted global supply chains. Landscape, boosting local manufacturing, but also potentially leading to selective inflationary pressures in specialized goods sectors.